Hello and welcome to our audience members joining us from across the globe. I'm Raymond Karam, the Chief Program and Development Officer here at AGSIW. We are truly pleased to be hosting this discussion today of the International Monetary Fund's report on the economic prospects and policy priorities for the GCC countries, focusing on the economic outlook in the region. This is an annual report from the IMF, and we've had the pleasure of hosting this discussion for 4 years in a row now. So I want to thank our partners at the IMF for, one, their hard work, and two, for making use of AGSIW's platform to discuss this important work. And to help us understand this report a bit better, we've assembled a truly stellar panel of experts. I'll introduce them here very briefly and share a link to their full bios in the chat. First, I'd like to welcome Yevgeniya Korniyenko, Senior Economist in the IMF's GCC division in the Middle East and Central Asia Department. Previously, she was the UAE desk at the IMF and was a Senior Economist in the Strategy, Policy and Review Department, working on advanced economies and external sector issues. Also, a warm welcome to our friend Amine Mati, Assistant Director in the IMF's Middle East and Central Asia Department. Since January 2022, he has been the IMF's Mission Chief for Saudi Arabia and the head of the IMF's GCC division. He has worked in the IMF's Middle East and Central Asia, European, and Fiscal Affairs departments, covering a wide range of countries. I'm also happy to welcome back our friend Alia Moubayed, Managing Director at Jefferies. She is an experienced economist, policy practitioner, and strategist with more than 25 years of experience in government, international financial institutions, financial markets, and think tanks. Last but not least is Dr. Nasser Saidi, the founder and president of Nasser, Saidi and Associates. He previously served as the chief economist and head of external relations of Dubai International Financial Center and the executive director of the Hawkama Institute for Corporate Governance. He was the Minister of Economy and Trade and Minister of Industry of Lebanon between 1998 and 2000, and the Vice Governor of the Central Bank of Lebanon from 1993 to 1998 and 1998 to 2003. Moderating the session today is my colleague Tim Callen, visiting fellow at AGSIW. He's a former assistant director in the Middle East and Central Asia Department at the IMF, and he served as the IMF's mission chief for Saudi Arabia and the chief of the Gulf Cooperation Council Countries Division from 2012 to 2021. And with that, Tim, over to you.
Thank you very much, Raymond, and hello to everybody. Let me add my welcome to our great group of panelists. I think we're in for a really excellent presentation and discussion today. Just to further emphasize what Raymond said in terms of please add your question and answers as soon as you have them into the Q&A function. And we'll try and get to as many as we can. What we're going to do is first, Yevgeniya is going to make a brief presentation on the IMF report. We're going to then turn to Alia and Nasser to get their reactions to that. And then we'll have a panel discussion with the four panelists with the Q&As at the end. Without further ado, and to maximize the time we have with our panelists, I'm going to hand it over to Yevgeniya for the presentation.
Thank you, Karam, for presenting me, and also thank you, Tim, for organizing this event. I prepared some slides, which I'll try to share now. So thank you very much again, and it's a great pleasure for me to present the key findings and policy priorities for the GCC as discussed in the 2023 GCC report. I hope I can do it effectively in the next 15-20 minutes. I would like first to make a disclaimer. This report was prepared in September 2023 for the GCC ministerial meeting in October and is anchored by October 2023 World Economic Outlook projections and risks. We know that world situation has changed since then, which I will also briefly discuss, and Amine and myself will be happy to answer follow-up questions. I'll start from discussing GCC outlook, GCC economic developments, and outlook and risks. In 2023, overall GCC economic activity decelerated, as shown on the left-hand chart, but non-hydrocarbon growth remains robust, driven by higher domestic demand and investments, gross capital inflows, and reforms. The highest gross non-hydrocarbon growth rates are expected in Saudi Arabia and the UAE. Growth is normalizing in Qatar and slowing, but remaining above 3% in Bahrain and Kuwait. Oil production depends, of course, on OPEC Plus decisions and unilateral cuts by Saudi Arabia, and is expected to register negative growth in 2023 and will remain subdued in the near term. GCC inflation remains contained and is falling. In 2022, inflation in tradables drove GCC inflation, but subsided by the end of the year due to the higher interest rates, slowing global growth, and continued use of subsidies and caps on certain products by the GCC countries. Non-tradables inflation picked up that year heavily by the end of 2022, but has trended down since February 2023 as well, resulting in GCC inflation slowing to about 1.6% year-on-year in August 2023, and we estimate headline GCC inflation at 2.6% in 2023, and slowing further to 2.3% in 2024, while also converging with that of the US in the medium term with pegs in place. In the report, we examined 3 possible channels of inflation pass-through in the GCC: commodity prices, inflation uncertainty, and impact of market power, or so-called greedflation on GCC inflation. On pass-through of commodity prices, it's a chart on the left. We observed that there is a significant difference between the global and GCC food and fuel prices increases in 2022. For instance, only the UAE fully adjusted fuel prices, domestic fuel prices, while food prices adjusted only partially in all GCC countries. And we attribute it to the existing and introduced caps on, for example, staple goods, energy products in GCC countries. It is worth noting that food, energy, and utilities account for a significant share of GCC CPI baskets. For example, in the UAE, they account for close to 50% of CPI basket. We also studied inflation expectations in the GCC as one of the potential reasons for high inflation in 2022 by approximating the inflation expectations with an indicator of inflation uncertainty, which is based on dispersion in one-year inflation for consensus forecasts. We observed that after spiking in 2020, inflation uncertainty around GCC inflation have subsided in 2023, but it still remains higher than, for example, what we've seen in 2014. Our analysis also indicates that increase in corporate market power in the GCC after COVID did not contribute to GCC inflation surge in 2022. In fact, we discovered a negative correlation between corporate market power and inflation in the GCC, as demonstrated on the right-hand side with the blue line. And there are more details in the report annexes. In terms of fiscal performance, GCC fiscal performance remained robust, again supported by relatively high oil prices, strong non-hydrocarbon growth, and fiscal reforms, including to contain wage bill, tax policy, and revenue administration reforms. Nevertheless, fiscal surpluses are expected to decrease in 2023, with some countries, Saudi Arabia in particular, likely to go back to fiscal deficit. GCC countries accumulated large fiscal buffers, also with significant variation within the region. GCC sovereign wealth funds are now holding close to $4 trillion in their assets. We also estimated that GCC net wealth ranging from a small positive in Bahrain to a positive of 1,640% of GDP in Kuwait. And of course, for the GCC, the highest value, for the countries in the GCC with the highest value of natural resources, we have the largest estimated assets. Fiscal prudence and strong economic activity also resulted in a further decrease of the GCC general government debt ratio in 2023 to pretty much pre-pandemic levels. External surpluses in GCC remain high. Current account surplus is expected to decrease to 9.6% of GDP in 2023, from historically high surplus of 16% in 2022. Also reflecting lower oil prices, slower global growth and trade, and also accelerated GCC imports in line with the rebound in domestic demand. It is important to note that GCC trade and openness indicators continue to improve, supported, of course, by reforms that we've seen in recent years, by the negotiation of free trade agreements and also regional initiatives. Since the pandemic, GCC has been more successful in attracting foreign direct investment as a percentage of their GDPs and advanced economies and emerging markets, as shown on the right-hand side. The UAE continues to be the largest FDI recipient in the region, with inflows estimated at more than 5% of the GDP. The success in the UAE is driven, of course, by strong economic activity, but also could be attributed to regulatory reforms, such as legislative changes in 2021 that allowed 100% foreign ownership of onshore UAE companies, and also changes to the public-private partnership legislation in 2022. For financial and banking systems in the GCC countries remain well capitalized, liquid, and profitable. Capital ratios, as discussed in the report, continue to be well above regulatory requirements, while funding remains predominantly deposit-based. Profitability has improved, and non-performing loans ratios are low in aggregate. The tightening of global monetary policy has affected domestic bank lending and deposit rates to varying degrees in GCC. This has led to the moderation in credit growth in some GCC countries, but the impact has been limited by the abundant liquidity amid high oil prices. Private credit growth across GCC has mainly been influenced by idiosyncratic drivers of domestic demand growth rather than higher bank lending rates to date. In 2023, GCC financial markets also demonstrated resilience in the face of financial market turbulence in the US and Europe. External GCC sovereign spreads remained low and stable, and GCC has continued issuing local currency debt at varying maturities given in the capital markets, including green sukuk issuance by PIF in the UAE. Few words on outlook and risks. Despite the global headwinds, GCC near-term outlook remains positive, driven by increased capital investment and supported by structural reforms implementation. Outlook, of course, is subject to both downside and upside risks in a highly uncertain environment, and the balance of risk is likely to change in the view of recent events. On the downside, we see risks of lower hydrocarbon prices due to subdued global activity and higher for longer interest rates that could reduce trade and tourism, slow growth and credit, and also pressure fiscal and external balances and affect vulnerable corporates in the GCC. For instance, we estimate that 1 percentage point negative shock in China growth could reduce non-oil output in the GCC by about 0.25% in the same year as the shock, and by about 0.6% after 4 years, as shown on the chart by the blue line. The details of this analysis can also be found in box 2 of the report. On the upside, we see potentially higher than expected oil production if the OPEC plus production cuts are reversed. Also potentially higher oil prices if expectation of a supply shortfall persists, faster capital investments, and potential for accelerated implementation of structural reforms. Also, in the medium to long term, GCC region is facing challenges related to the energy transition, as we know, and risk of global fragmentation. The future of oil prices is uncertain and will be determined by both supply and demand factors and their interplay. Potential underinvestment in fossil fuels in the next 10 to 15 years could support high oil prices, despite the push for decarbonization, as demonstrated by the black line on the chart. However, global decarbonization efforts could accelerate, leading to disorderly climate transition and posing significant challenges for the GCC financial system. This is a risk that needs to be monitored closely and preempted. However, Energy transition also presents new opportunities for the GCC, which could capitalize on their already existing energy sector infrastructure and expertise, but also leverage region's comparative advantage in solar, wind, and hydrogen production. Nevertheless, as discussed in IR and others 2023 IMF staff discussion paper, the risk of global fragmentation could entail significant economic cost in aggregate and including for the GCC due to increased restrictions on cross-border movement of capital, goods, technology, labor, and it could also delay energy transition. As mentioned earlier, the report was prepared before the events of October 7, 2023, and since then the downside risks and uncertainty for the region have increased. So far, the spillovers have been contained. We have not seen any major impact of the conflict in Gaza and Israel on GCC economies beyond very limited, imminent and short-lived impacts on oil, financial markets, and tourism. However, if the conflict intensifies or spreads, some Middle Eastern economies could be impacted by trade and supply chains if they are disrupted. For example, the Red Sea and Strait of Hormuz are crucial maritime choke points for oil tankers and container shipping. 20% of global oil trade is sent via Strait of Hormuz, and Mandeb Strait is an important passage for north-south trade in energy and other goods. Also, GCC countries have significant spare capacity of oil and could also benefit if oil prices go up due to the escalation. They could be negatively impacted by the reduced trade, and if any of the production facilities are targeted, as we've seen in 2018 in Saudi Arabia, and also a significant increase in insurance transportation costs, as shown on the right chart, which will then spill over to inflation if the crisis prolongs. Quickly, I will also discuss policy priorities for the GCC as we see them in the report. To enhance productivity, diversify the economy, and prepare for the energy transition. And we split the policy priorities in the short-term, near-term, and the medium-term policies. So in the near term, the emphasis should be done on maintaining balanced growth and resilience. The momentum of reforms should be maintained and accelerated. And fiscal policy should be supportive but prudent to avoid procyclicality and keep inflation in check. GCC fiscal buffers should continue to be strengthened to ensure long-term sustainability and resilience. However, if risks materialize and growth slows sharply, countries with fiscal space could deploy targeted and temporary fiscal measures. Monetary policy in GCC should continue to follow that of the US, given the fixed exchange rates, but close monitoring of banks' dollar funding liquidity and credit quality, as well as real estate markets and bank sovereign nexus, remains warranted to preserve financial stability. In the medium term, fiscal policy, fiscal structural reforms should be stepped up to enhance fiscal sustainability. In this regard, GCC countries should continue advancing the development of their credible, rule-based and forward-looking medium-term fiscal frameworks, and also progress on sovereign asset liability management frameworks to improve fiscal policy efficiency and fiscal risk monitoring and management. GCC countries also should continue pursuing fiscal consolidation, as I already said, in the near term and in the medium term, through non-hydrocarbon revenue mobilization, spending rationalization, and higher efficiency. Gradual removal of fuel and utility subsidies will support fiscal consolidation, but also help energy transition, but it should be done together with strengthening GCC social safety nets. Policies are also needed to foster an enabling environment for private green finance that will fill the financing gap and reduce fiscal burdens. Lastly, it is important to say that GCC countries should continue focusing on further enhancing fiscal transparency to strengthen the credibility of medium-term fiscal frameworks and reduce implementation risks. For the financial sector, we emphasize the importance of continuing financial sector reforms to support growth and stability. These include continued development and deepening of financial and capital markets, strengthening of macroprudential and regulatory frameworks, ensuring effective supervision of financial sector, including digital and fintech activities, while also advancing digitalization and fintech growth, fostering sustainable finance, and implementing measures to strengthen AML safety. And lastly, the report emphasizes the importance of maintaining momentum on structural policies that focus on diversifying GCC economies and also achieving energy transition and net zero goals. Reforms aimed at further advancing product market regulations, labor markets, gender balance, and governance will help to spur growth. Efficient investment in digital and green initiatives will help to accelerate transformation and support energy transition, and leveling the playing field and improving regulatory environment will further foster FDI. Industrial policy that has been used actively by GCC should be carefully calibrated to avoid substituting for the structural reforms while minimizing related inefficiencies. It is also important to avoid crowding out the private sector while scaling up public investments. And last point is that continued regional and global integration and cooperation would help GCC to expand their markets, attract FDI, and grow trade, which will also help diversification efforts. I'll stop here and pass the floor to Amine, Alia, and Nasser. Thank you very much.
Thank you very much, Yevgeniya. Maybe I can ask Dr. Nasser to go first and offer his perspectives on the report and any other issues he wants to discuss. Nasser, the screen is yours. Thank you.
Well, first, I'd like to thank the Institute, the Arab Gulf Institute in Washington, for inviting me, as well as the fund. So let me make a couple of preliminary remarks. The first, I think, is that this is a comprehensive report and very welcome. So it covers all aspects in terms of economic policy, monetary policy, exchange rate policy, fiscal, trade, climate, digitalization, and to the benefit of everybody who's an economist and anybody who looks at the GCC, it contains a wealth of information, which is not necessarily easy to get. So I commend the IMF for making all this available. And I note a couple of things which are different in emphasis from previous years. One, and this is very welcome, the IMF report on the GCC now highlights the importance of China and Asia in general, and the impact of developments in growth and trade in China and its impact on the GCC. This is very welcome because, and I'm going to develop this a little bit, what we've seen is really a tectonic shift in the global economy towards Asia and towards China. And that has reflected itself in the trade patterns of the GCC countries. So China today and Asia are the main importer of energy, oil and gas from the GCC countries. And therefore, we need to think in the future of how do we model and integrate analysis of China into analysis of what's happening in the GCC countries. So I point that for the future. Second, and very, very appropriate, is the increased focus on the energy transition and climate change. And this is a new feature, I think, in terms of IMF work on the GCC, because it highlights also one of the main challenges over the medium and longer term that the GCC countries are going to be facing. So that again is welcome. Another aspect, I think, points to the fact that although energy continues to dominate overall growth patterns in the GCC, increasingly non-hydrocarbon is becoming increasingly important. So if I look at the share of and the contribution of non-hydro, non-oil to overall growth, that is higher today and more stable than it was in the past. Now, that's important because, of course, economic diversification in all its various aspects in terms of output, government revenue, and trade is going to be critical for the GCC economies in the years moving forward. So that, again, I think, is an important point. And it's also, I think, important to understand why this has happened. If you look at the pandemic, of course, it had a severe effect globally on trade, on growth, on mobility. But, and this is interesting, the GCC countries, on average, recovered faster than the rest of the world. Second, as a result of the pandemic, they went back to the drawing board and asked themselves, what changes in policies should I implement? And as a result of that, and as the report points out, you had a series of reforms. We're looking at trade, for example, trade liberalization. And this is a new feature. If I look across the world, the GCC countries only have 5 regional trade agreements compared to, I think, 160 or 161 for the EU. We're now seeing the GCC accelerating those trade agreements. And I want to make a couple of comments on that. And importantly, the fact that they recovered faster also is a result of the resilience of their public health systems. And this is very interesting because the public health systems had not been shocked in the past. I mean, they, unlike Asia, they didn't have bird flu or Asian flu or other types. So this was the first test of public health systems, and they responded extremely well. And so they recovered faster. This attracted people, this attracted FDI, it attracted capital. The other thing, of course, that also happened as a result of this is that they started rethinking what they should be doing in terms of subsidies, very well illustrated by the UAE, which no longer has fuel subsidies. And what that does is implies greater fiscal resilience and the buildup of buffers, of fiscal buffers. So what we're seeing now is maybe a new development model. And let me just try to look more in terms of the medium term, given what's happening in the region. The first thing I think we need to realize is that we're in a situation of a new Cold War. The IMF has pointed out that we are already in it. It's not like it is likely to happen. We are already in it. And the IMF, when it looks forward, is saying that new Cold War could have severe impact on global growth due to reconfiguration of global supply chains, de-risking China, and various other elements that could mean financial instability as well. So what we have is a reconfiguration of globalization, which is happening. The issue for the GCC countries is how should they respond to that? Because it is happening. The other element which is important and which is pointed out in the report is the issue of new technologies and the digital economy. And here again, I commend the IMF for bringing this issue up. Structural change is bound to happen insofar as the GCC economies are. So over even the short term, we need to think about how they're going to adjust to the energy transition. How are they going to adjust to climate change? How are they going to adjust to the digital economy? And for me, I think what's interesting in the report and when we think about the analysis moving forward, what it means is that the GCC countries have got to think much more regionally, going towards greater regional integration of the GCC countries. There's also another element which I call regionalized globalization, by which I mean that the GCC countries can gradually integrate other Middle East economies, which are not globally integrated, into their supply chains. Now, what this means is that the GCC will become globally integrated and globally integrate many of the countries of the region. I think that's very positive in terms of moving forward. Two other elements I think are critical, and the report mentions them, but I think we need more development of that. One of them has to do with the energy transition. The report rightly points to the fact that the energy transition and decarbonization globally could pose an existential risk because a large part of your wealth comes from oil and gas. And that could mean that down the line, oil prices could be much lower, and therefore you need to adjust now. You cannot wait for that to happen. And that means energy transition policies have got to be a major focus. Now, the very positive thing I find working very much in the Gulf is that the GCC countries have taken that on board. So if I look at the investments done in renewable energy and climate tech, they are at the forefront in terms of that. So the positive thing looking forward is that the GCC countries remain a hub for traditional sources of energy, oil and gas, but they're developing green energy, including hydrogen, and they're going to be able to export that. And they're going to be increasingly reliant on solar. Of course, what that means is that we have a focus for new economic development with two elements. One is digital economy, and again, the report points out that they've made, and they are at the forefront in terms of digital infrastructure and access to digital infrastructure. And at the same time, they've got new energy. So over the medium term, the economic prospects are very strong. Two other remarks, I think, which are critical as we move forward. And continuing this issue of climate action. If you look at the report, it rightly points to the fact that SDG 13, which is about climate action, looks fairly low. I mean, we're not there yet, although there have been large investments. And here I'd like to make a suggestion because the IMF now has a climate dashboard. You've developed a climate dashboard. And I found that extremely useful. Now, what the climate dashboard does is it looks at various aspects of addressing climate change and the various dimensions. And it points to climate risk mitigation, climate adaptation, climate finance, climate data. So what I'd like to suggest, and this is also as a result of COP28, is that many countries, including the GCC and MENA countries, have made commitments in terms of net zero emissions and the rest. But we don't have a monitoring mechanism. I would like to suggest that the IMF uses that dashboard as part of the annual Article 4. So when you're visiting the various countries, you use that dashboard. You've also developed a number of tools in terms of climate adaptation, I think we should usefully use those, and I would welcome if the IMF does that. One final comment is that there's been a lot of focus, including at COP28, on climate risk mitigation, which is really an invitation to increase energy efficiency, go into electric vehicles and the like. All of this is meant to reduce our risks in terms of climate. But what is very clear for our region in particular and for the GCC is that climate risks for our region are much higher than for the rest of the world. Whether it's water stress, higher temperature, desertification, impact on agriculture, climate-induced migration, all of those are major risks for the region. And therefore, climate adaptation is going to be critical moving forward. Climate adaptation means making investments to make sure that our infrastructure, public utilities, housing, you name it, all of that is resilient to climate change. And if you look at the numbers involved, the IMF, I think, points to about 4% of GDP in investments that are going to be required. That is massive. And it also has implications for fiscal policy. And therefore, I very much welcome the recommendations made by the IMF of phasing out subsidies, maybe introducing carbon taxation, and increasingly focus on climate adaptation. But one point I think is important is that we have not worked out what the impact is on industry, particularly energy intensive industries, of phasing out fossil fuel subsidies. I mean, that's still work in progress. So let me end with just one thing. All of this, in terms of financing, means that we're going to require massive investments in terms of the energy transition and climate adaptation. And again, once more, it means that financial sector development has got to be a major priority as we move forward. The report rightly points out that the GCC countries have not pursued pro-cyclical fiscal policies, which is a big change from the past. So they're maturing from a fiscal point of view. They're developing their debt markets. And I think that is something that we will need to focus on in terms of increased green finance and finance adaptation, climate finance adaptation. So let me end there. And perhaps later on, we can come back to what's happening in Gaza and the Red Sea.
Very good.
Thank you.
Thank you very much, Nasser. Very insightful. I'm going to turn to Alia to get her comments. Just before I do so, just to remind people, if they have questions, please put them in the Q&A function, and we'll get to as many as we can. Okay, Alia, the screen is yours.
Yes, thank you again, Tim, and thank you for the IMF team and for Gulf State Institute to bring me on board for this very insightful discussion. Now, what I will try to focus on, as discussed and agreed with you, is really how the markets are looking at developments in the GCC, and to what extent the way that financial markets are pricing the risk in the Gulf states reflect the assessments that you're making in the report. So I'll try to have three messages. The first one is that we broadly, what we sense financial markets assessment about the GCC condition is very much in line with what you're saying, but that we seem to see that there is a big concern that the countries are facing significant challenges in the year ahead, in 2024. And we are starting actually in seeing spreads widening more or less across the board in the GCC. But at the same time, I think we also agree with you that almost all countries have enough fiscal space and the appropriate policy frameworks to deal with those challenges. And you have rightly outlined this in your report. However, I think where financial markets seem to be most concerned is about really the growth momentum. In particular, this is the case because not only financial markets are very concerned about the spillovers from the geopolitical tensions that the region and geoeconomic fragmentation will result in. But more so, the concern about growth is really about what is happening on the China growth front, and your report has very usefully actually identified and quantified the direct impact of a slowdown in China's growth on GCC in particular, and gave us a better understanding of the trade and FDI and financing linkages. But I also think that the concern about growth in 2024 is linked to this mounting concern that global financial conditions are likely to remain tight longer than expected. I mean, even us at Jefferies, we were expecting at the beginning that the Fed would start cutting in March, but now increasingly we are seeing that the probability of advanced economies, central banks cutting is likely to be delayed. And the recent comments coming out of some central bankers in the European Union largely reflect that trend. And this obviously will have a direct impact on the GCC, as also your report rightly points out, in the sense that the implication for higher for longer or delayed rate cuts will delay the expected revival in private sector growth that would result from higher private sector credit growth. We have seen a slowdown, and the report points that out. But I think in an environment of lower oil prices, and previous IMF research has shown that in periods of low oil prices, tighter monetary condition will impact, or the impact on non-oil private sector growth is actually going to be stronger, and therefore delaying the much needed revival that we have been waiting for. So I think the main concern is about the weaker growth in a tighter monetary policy stance persisting in 2024 globally, and again of lower oil prices that will affect liquidity and therefore the credit impulse the economy. The second concern that we share also is the risk about inflation, the fact that the Red Sea disruptions and spillovers to disruptions in supply chain will inevitably translate imported inflation given the pegged exchange rate, and that could also put the fiscal reform agenda, and in particular what Dr. Saidi much needed, basically, or awaited pace of subsidy reduction could delay it further, because ideally you would have wanted to start reducing subsidy in a period of lower prices and start also reversing some of the caps that still exist on some fuel and utility prices in many of the GCC countries. And this broader environment of potentially renewed inflationary pressure will put this tension again and policy trade-offs back to the fore. But I think, and maybe I'll close there in terms of the first part on our assessment, is that we remain very much, I think markets remain very much concerned about the fact that we are adjusting rather still slowly, despite the policy announcements to embrace the BRICS and deal with an increasingly geo-economically fragmented environment. But I think the de-risking from that we are seeing from the EU and from the US about China, we are seeing somehow a different stance in the GCC that could obviously spillover, as I mentioned previously, and your report points out, in terms of the spillover from the lower China growth and the greater exposure to the shifting, increasing supply chain connectivity of China with ASEAN. And that obviously is developing in the GCC, but we have less visibility as to the speed at which that impact growth and trade moving ahead. This is more broadly some of the assessment on the macro level. My second message is, I think, to the report is that markets do not seem to think that there is one narrative that fits all in the GCC. And I think also that is while the report is talking about general GCC trends, but I think it is very welcome that you try to help us understand better the differentiation. And I think what we have seen recently, and I'll give some examples, is that markets have been reacting differently to the way oil prices have been impacting, lower oil prices have been impacting GCC countries. It is very clear that lower oil prices is now driving less and less credit risk towards the GCC countries. And in particular, there is more and more attention or more and more impetus given and importance given to the pace and the depth and the credibility of structural reforms that individual GCC countries. And we know for a fact that there is a very wide divergence in terms of the breadth and the depth and the speed at which individual GCC countries are embracing to implement those reforms. In particular, for example, we see clearly that credit spreads have been, or markets have been reacting positively to countries like Oman, and shying away from reacting negatively when oil prices go down, because markets feel much more comfortable in the way Omanis have been implementing a medium-term fiscal reform, a transparency in the fiscal framework. The same for Saudi Arabia. We see that less in countries across the region, and in particular Kuwait and Bahrain. And that will continue to drive this credit across the region. Another important element is also of differentiation is the fact relates to FDI. We clearly see that there is continued concern and you point out in your reports that much of the inflows that the region has been benefiting from remain debt driven or debt creating flows, except basically maybe the UAE, where the concentration of FDI flows remains the highest towards that country, and the rest of the region is benefiting less about FDI. And I think it would be very useful do a dashboard that helps the kind of structural reforms that many of these GCC countries have been implementing and delivering upon. Similarly to what we have seen, for example, the EBRD do in their transition reports in Eastern and Central Europe in the past, when they were trying to assess the depth and breadth of structural reform, and these have actually resulted in increasing competition, not necessarily a race to the bottom, but really a race towards accelerating these structural reform as a way for inducing further FDI. And it is very clear, and as your report, one reason mainly why, despite their advanced level of per capita income, the GCC countries have a much lower level of service export to GDP, that to a large extent, markets explain that by the fact that the FDI led growth is still very low. So that's about the importance of maybe keeping this, keeping us improving our understanding through your reporting about this differentiation across the GCC, because clearly we do not see one narrative. And finally, my last message is about what could help basically improve market understanding of credit risk. Your report sheds a great light on the elements, but I think we cannot but emphasize your three maybe policy reforms that your reports point out to, and that I think financial markets would be extremely responsive to, and that could help reflect that in the cost of borrowing of countries. I think the first reforms that you rightly point out is about importance of furthering the progress on the fiscal framework. Those fiscal framework that fiscal structure reform, in particular the upgrading the medium-term fiscal framework like Saudi and Oman have done. We look forward to seeing that in Bahrain, UAE, and Kuwait and Qatar. But I think also your point about incorporating the sovereign wealth fund and the SOEs as part of a broader public sector asset and liability management. I think of the key areas, and this has been echoed by rating agencies recently, preventing further upgrades of some of the lower rated GCC credits, is the lack of understanding of the interplay between the central government and the rest of the public sector on the one hand, and the lack of visibility about contingent liability and fiscal risk. And we cannot but underscore of seeing that developed further, because that on credit risk. And I think finally, the more important element is to see more proactive debt management frameworks being implemented and reflected. Again, I think Saudi and Oman stand out, not only about making their debt management strategies clearly outlined, but also engaging proactively in liability management and and transparency with markets. These have been considerably well received and reflected in significant successive upgrades in rating of Oman recently. And I think if we had seen this also reflected in Bahrain, it would have considerably changed the credit outlook for Bahrain. I will stop here and would be happy to answer further question and engage in discussion.
Very good. Thank you very much, Alia. I wanted to give Amine and Yevgeniya an opportunity before we turn to questions to see if they want to respond to any of the points raised by Nasser and Alia. So, Amine, I see your mic is off, so I'll give the floor to you.
Mic is off means I'm ready to talk. Thank you both. Thank you for all the comments and the feedback on the report and the discussion. Look, we agree on the main priorities and the challenges facing the GCC, and I think you saw some of that developed in the report, noted the issues about the dashboard on climate and on structural reforms, although we'll see whether we'll do it in terms of colors or not, but I think the point of all of these countries are at different times in terms of reforms, in terms of progress and advancement, I think is noted. I wanted to flag, 2-3 issues in terms of some of the comments that were made on Alia's point in terms of economic growth and linked a bit to Nasser's point on China. The first one is that on tight global financial conditions, yes, if it stays for longer, the banking system, the GCC, for the most part, the impact will still be positive because of the net interest margin and on capitalization. And Alia did point out that we had our research that because of high liquidity, when you have high oil prices, when global financial conditions are tightened, the impact that we found on both private sector credit or on growth in the economy is limited. Just wanted to flag that the threshold price there is really, I think we have forgotten where we were in terms of different prices, and threshold price there was $45 a barrel. I think now we've seen we were used at some point to seeing price above $100, now 80. Prices still have not fallen below 70. I mean, I think in terms of the Brent, I'm not talking West Texas Intermediate. So, that's still quite high compared to where we were. Actually today, I haven't seen today because these prices are like yo-yo. But, given what's happening in the Red Sea, they were above 80. So it's still talking about comfortable prices. And here, even for the energy transition, and I like the point made by Nasser to try to emphasize the need for investment, which is also part of our report in terms of green investment. And I think this is the point that's important for all these GCC economies, is that oil price, during some of this transition is still likely to remain high because there's still some undersupply of investment. Yes, the US shale oil gas is there and we have some production, but overall, there's still going to be more production, and a lot of the countries are counting on that. We're expanding capacity. Saudi Arabia going to 13 million barrels a day by 2027. And therefore, it should be using some of that opportunity of a higher oil price to increase the investment and, increase the returns that are going to come from that. And I think that's important to keep. We're not talking about a net zero demand scenario where oil is going to disappear and oil price is going to be lower. I think there's going to be still quite a lot of time during the transition where oil prices would be higher, where the higher oil proceeds can be used to facilitate the energy transition. And I think that's the point that needs to be emphasized. And I think, the fact that the, GCC regional trade needs to be encouraged, I think this is something that should be fostered. I think a lot of the trade is still happening within GCC, but there is still a lot more that can happen. And I think I saw a question in the chat that I might as well just answer now about the GCC agreement, or the fact that new founded internal competition within GCC and the impact of single protectionist measures have on the economic prospect. We haven't looked particularly at that, but clearly the more open those countries are, this is a large market, and this is the more beneficial it will be for trade and growth in the country. So some of these protectionist measures should be resisted. And by the way, this is, when, we have Saudi Arabia and UAE joining the BRICS, we have the IMF corridor, and within that whole concept, the idea is that you are opening up trade, not closing trade, right? So this idea that these would be beneficial for the GCC if this is opening up for trade. Now, Tim, I'm not going to answer the questions, but I'm happy to, I see in the chat, wanted to maybe emphasize the issue that was raised, and I think also indirectly in the question, and also about inflation concerns and the Red Sea. Look, I mean, inflation in the region is very low. Keeps going back. You look at the Saudi numbers, the last one is 1.5%. Even when we had wholesale price that was in double digit growing in Saudi Arabia, inflation was not driven by some of the domestic factors. We see rents, for example. So I think, let's see what will be the impact on the Red Sea in terms of the shipping. At some point, some of those costs will materialize, but, inflation, even during COVID, when supply chains were strained, remained relatively contained in the GCC compared to others. And some of that, reflects some of the administered prices, including what has happened on fuel prices. And I think it would be good to keep that in mind. I'll stop here and see whether Yevgeniya want to add another few points for emphasis. Otherwise, wait for your guidance, team, on answering some of the chat questions that I see.
Thank you, Amine. I think, yes, I had the same point on regional integration and also synergies that you already covered, is that I think overall what GCC are doing now is basically like strengthening their relationship with partners outside the region, while also preserving and enhancing the relationship within the region. So I think they work on both strategies, and it is pretty much a low-hanging fruit to increase the gross trade and through improving relationships through the free trade agreements, also increase FDI and reduction of barriers to trade, right? And like improvement in movement of resources. This is ultimately what will help them to grow faster and also increase productivity and reap the benefits from structural reforms that they're introducing and implementing currently. And within the region, we see also that they're working on enhancing, not just kind of like their cooperation. So recently signed the unilateral visa agreement that will allow tourism within the one visa for tourism within all the GCC countries. They are also working on agreements on joint investments into the renewable sector, which is very important for the energy transition, as Nasser also was saying. So I think working on cooperation within the GCC, but also expanding to other regions, will serve countries well in this new evolving geopolitical and geoeconomic landscape. I'll stop here.
Very good. Thank you all for those comments. So let me just turn and ask. There are a couple of good questions. I see Nasser. Okay, Nasser, go ahead and be brief, and then let me get to some of the questions.
I just want to come back to this issue of the new wave of trade agreements. Yeah. And CEPAs that the UAE and now others are following up, and FTAs. Because I think what we're living through, and we need to be cognizant of that, is structural transformation. Yeah. And I see a new spirit within the GCC countries saying, I now want to use a new policy tool, namely trade agreements. Remember that we haven't had any. The most recent one, you had Singapore, and then recently Korea. But there's now a new wave, and this follows, I think, the visit of President Xi of China in December last year to Saudi, that has led to the impetus that we need to rethink these free trade agreements for the GCC. And I think the main point here is that, and this I think the IMF should encourage, is for them to work collectively. They should be trading and negotiating as a bloc, not independently country by country, in order to benefit from market power. So I think I'd love to see the IMF playing a role of bringing parties together in terms of working groups on trade. The other one has to do with digitalization. Everybody, I mean, the report points out to the fact that the hard infrastructure is there. But what you need to do is to integrate it. And if you develop that trade infrastructure, that digital infrastructure, this allows you to go into digital trade and digital services. We know globally that services is faster growing than trade in goods and commodities. So what we need to have happen with the GCC is to be able to use e-commerce and digital trade to increase their share of trade services. So that, again, is an area where you need more cooperation. The third one has to do with climate. Climate does not recognize borders. It couldn't care less where borders start and where they end. And so again, here, I think you need common action. Saudi's already called for this, and I think we should welcome that call for greater regional cooperation on addressing climate risks. And what that means effectively is that when I plan ahead my infrastructure, whether it's public utilities, oil energy, water, etc., transport systems, I need much more integration there. So again, there's a call for integration, because otherwise you won't benefit from the economies of scale and greater efficiency of having integrated infrastructure, and where you can build on that in terms of having infrastructure markets, say for electricity, yeah, and feed-in tariffs and all the rest. So there's quite a bit. So my main point really is that structural change is happening. So it's not business as usual any longer. Even for things like exchange rates, the IMF, the report says, stick to the US dollar. What I'm hearing across the region is a slightly different story, whereby they're saying, my main trade partner today is Asia and particularly China. So maybe I should start going towards a basket like Kuwait has done, which includes the US dollar, euro, but maybe also the yuan and other currencies. And that would give me a great more flexibility. So just a couple of ideas there, I think.
So we're talking about structural reforms and impact. And one of the questions is, we talk about the non-oil sectors in the GCC, but are they really independent from the hydrocarbon sector? You have, petrochemicals, you have a lot of sectors dependent on government or broader public sector spending, which, at least at a second derivative are linked to oil. So are we seeing any evidence of, more independent growth coming in the non-oil sectors in the GCC? Open for any of the panelists who'd like to comment on that.
I'm happy to answer that. Look, when you look at it in the past, the link was a lot stronger. I think that's undeniable. And why is that? Because oil prices went up, you had a pro-cyclical fiscal policy, and you saw it directly through wages and government spending and others. And the link was there, and then the minute oil prices went down, then all those projects, everything stopped. Now, is the link still strong today and some of those, construction and projects are there? Yes, the link is still there, but the link is a lot of the spending decisions on the central government for many of the countries GCC have been a bit delinked from that. And you see it with wages contained, you see it with some of the spending increasing by less, particularly on current spending. You're seeing some of the investment spending going up. But what we are seeing, and Saudi Arabia is case in point, is that you have Sovereign Wealth Fund, the PIF spending, you have the National Development Fund spending. And what's important here is to put that within a medium-term fiscal framework and making sure that the spending is happening because it's planned. It doesn't depend on oil price fluctuations. And here we're seeing, there's been, I think there's a question on fiscal on Saudi later. I can answer that. But we've seen that some acceleration of the spending, but that would still be appropriate as long as it is part of the whole medium-term fiscal framework. And here, to answer back your question, is that as long as the spending patterns that we're seeing now are continuing as part of that framework, irrespective of what happens to the oil price and the oil proceeds, then we're seeing some of the de-link. Although if oil prices do collapse, we're going to have, I'm sure, some reprioritization. But what I'm saying is that that spending should continue in line with what is being planned. This is why you're seeing countries like Saudi, others also using bond issuances, even though they have quite a lot of proceeds, because they are looking at it from a more medium-term perspective. So if you look at the correlation with what has happened, that has decreased. Is it still there? Yes, but it's much less than before, because the main channel that used to be there was the central government, and that channel of recycling of the dollars through the government spending has diminished a bit.
Nasser or Alia or Yevgeniya, anybody want to add to that?
There's one point I think we haven't addressed, and I think the report is a little bit silent on it, namely privatization. what we're seeing across the region, but particularly UAE and Saudi, and to a lesser extent in the other countries, is precisely to this point that I want to try to divorce the non-oil sector from what's happening in oil prices, is the opening up of many assets to the private sector. I live mainly in Dubai, and when I look at what the UAE has done in terms of things like using SALIC for pricing road transport, bringing pipelines and part of the oil sector onto the market, is a very good way to do two things. One is to attract FDI and encourage greater private sector investment, but also importantly, at a time of energy transition, it's attracting new technology. Think of AI. AI is now being used to manage oil wells, to manage pipelines and the rest. And that's mainly driven by the private sector. So I think what we're also seeing, apart from the massive mega projects like NEOM and others in Saudi Arabia, is much greater involvement of the private sector. And when I see that, it's driving a lot of the non-oil growth, particularly things like tourism, hospitality, and the like services, but it's also going into manufacturing and industry. So I think we should be cognizant and register that.
Alia, maybe I could just ask you, so let's say we're in an environment later this year where oil prices are down, $10, $15 from their current situation. What do you see as being the access to financial markets for the Gulf countries, and how that may vary across the countries in an environment where fiscal deficits would clearly be larger and they would need to borrow? Could you maybe elaborate a little on that?
Sure, Tim. I think, now given the global environment and still the rate situation, global financial conditions, we were hoping that the market could become more open to more generally emerging markets. But the GCC seemed to be, in our region, still the only group of countries that financial markets are actually very eager to invest in, and this is where markets will continue to be open for them, even in an environment for lower oil prices. The reason why is exactly the reasons that your report is actually confirming. And the first, that the fiscal space in most of these countries, except maybe Bahrain, is actually very comfortable. It's general debt levels are relatively low. Fiscal, both in terms of stock and flow, at this level of oil prices, the concerns about fiscal sustainability or fiscal stress or external funding outlooks are very much contained, and in particular because of the previous liability management that they have done, that basically gives them a lot of room for markets engaging with them for further liability management. The second reason is the buffers. I think what we have seen over the last 12 to 15 months is that most of the GCC countries have considerably solidified their buffers. And therefore, a period of lower oil prices is not seen as a sign of stress like we have seen in the 2015 or other or period. And that goes back exactly for this perception that in most of the countries is solidly there. So I would expect market to continue have appetite for particularly investment grade issuance, as we have seen last week for the Saudi sovereign, just today for Oman Tel at the corporate level. But as I mentioned, I think in a period of low oil prices, markets could become more concerned about lacking this overall public sector vision, because they are seeing financial institutions that are government related and sovereigns coming to the market and issuing a lot. So the supply is quite ample. And as long as if oil prices remain low for a much longer and debt accumulates and pressure continues on oil growth because of restriction to supply, then I think we have to look closely at credit risk seeping into this need to see the broader public sector balance sheet rather than only remain focused on.
Thank you. So there are a couple of questions on fuel subsidies, and noting that there's been a recent cut in fuel subsidies in Saudi Arabia. Wondering what the prospects are for further reforms in Saudi and elsewhere in the region, and particularly asking about Kuwait, which is noted as a laggard in this area. So I don't know, Amine, Yevgeniya, whether you Nasser want to comment on this.
Clear, Saudi Arabia, this is part of their energy price reforms. They have each quarter they evaluate for a number of products, whether it's kerosene, whether it's diesel, and they increased diesel earlier this year by 25%, or last year, so 24, 23 all look the same. But then again, these are planned increases that are part of their strategy. Sorry, this is the time where my son decided to show up. Let me. Sorry. So as part of the subsidy reduction, Saudi Arabia and other, Saudi has announced as part of the vision to try to eliminate subsidies by 2030. They're announcing it. The one cap that's still remaining is on gasoline. Our recommendation is that these be removed, accelerated for the reason that Nasser and others have pointed out, creates fiscal space. These are now, represent about 6% of GDP. You look at the Aramco numbers, and we will see the actual numbers coming out. And I think for all of the countries, this is really one easy source of fiscal space that will benefit all. And let me just add that countries like Saudi Arabia and Nasser talked about digitalization. They have, very good social safety nets, and they have like these programs that the man and others that they can put in place, or the citizens account that they had when they had that can really help offset the impact on the most vulnerable and can accompany any of the energy subsidy reform. And I think this is something that should be accelerated.
Okay, good.
Maybe just a quick one,
yeah.
Tim, on Kuwait. There's a new government going to be formed, and the understanding is that maybe a number of reforms that have long been delayed might see the light moving forward. And I just want to add one element, because we haven't discussed this, and this is part of overall asset and liability management. The report rightly points to the enormous financial wealth and wealth of the GCC countries. But there's one aspect having to do with public commercial assets. Those are very substantial. And those can be, if appropriately managed, can be a major source of revenue. If I look at countries like Singapore and others and how they manage their public assets, that can raise 3 to 4% of GDP. So if you think about your roads, your airports, many of those public assets, a lot of land which is unexploited, which can be, then that could be another major source of revenue. I think it'll be good to start discussing that in any sovereign asset and liability management framework, along with the sovereign wealth funds and then the rest. But I think public assets and their management, greater efficiency there, could be a preparation for some of those assets for privatization, but could be a major source of revenue.
Okay. One issue I just wanted to come back to was the impact of the conflict in Gaza and potential for regional, broadening of that conflict. I think the presentation by Yevgeniya suggested sort of likely a relatively limited impact on the GCC. I hope I'm paraphrasing that fairly. But I wanted to give Nasser and Alia a chance to see whether they wanted to add anything to that and whether they agree with the broad assessment. Please, Nasser.
Okay. I think we need to look at various scenarios. The current scenario has been a limitation of the war to Gaza and to Palestine. The question is whether you're going to move to a scenario 2 and a scenario 2 where there are spillover effects potentially into my home country, Lebanon, into Egypt, and obviously to Yemen, as is currently happening. And the third scenario where it spreads across the region to involve potentially Iran. Now, each of those scenarios carries different types of risks and implications for energy prices, for disruption of supply chain that could be massive. We don't know at the moment. So as Yevgeniya was pointing out, so far the impact has been limited. When right after October 7, we saw a spike in oil prices and then diminished. There was an impact on CDS spreads. It's still there. Higher bond yields as capital left some of the markets. There's been an impact in terms of access to markets where banks and financial institutions of the region are now viewed as riskier than otherwise, and I think Alia was getting there. But so far, the impact has been limited. The main question is, are we going into a scenario 2 or a scenario 3? I think we don't have any visibility. But one thing I will comment on, what's happened is going to have long-term scarring effects in terms of how the region views the rest of the world and the issue of double standards. I think that'll leave long-term scarring effects. We don't know how it'll impact relations, but I think those scarring effects will be with us for a long time.
Yeah, I just wanted to add to that certainly the perception is that the longer this situation of uncertainty prevails, the longer, obviously, this perception that basically sovereign risk and business risk affiliated with the region will have to be priced in. It will affect shipping. It will affect transactions. It will affect basically it could delay investment projects, and no doubt there are still unforeseen basically tangible impact is not yet there, but the longer it stays, the more basically financial markets start pricing in the much more prolonged and a status quo, and that is what you really. The other thing I think is important in terms of spillover of Gaza, and I think it brings me back to something related but not necessarily related to the war, is about the role of the GCC in terms of supporting the rest of the region. And I think that is something that maybe in the next report is very much needed, because we are entering with the war a period where the rest of the region is going to depend on the role and the proactive, basically, role of aid, trade, diplomacy of the GCC in shaping the future outcomes of the region. And I think countries that have been systemically relying on GCC aid, like Egypt in particular, are going to be affected. Past the GCC economies will perform or will be impacted by the broader regional and global environment. And I think it would be very useful, maybe as part of your report in the next phase, to actually help us better understand the contribution of the GCC in terms of deploying their surpluses in solidifying their aid development framework and its impact on shaping what Dr. Saidi said, contributing or not to these other countries in the region into GCC supply chains and global supply. Very much of the ability to project the future of some countries relies today on the GCC support.
The IMF issued in September a report on Gaza, just a couple of weeks before the October events. And I would welcome certainly a revisiting and an updating of that report. Because the bottom line is we need to think post-conflict whenever that's going to happen. We're going to have to think of reconstruction, the financing of that reconstruction. And obviously that's not independent of what the political scenario is. We know that. But some technical work needs to be done, most likely by the fund and the bank, in terms of what are the reconstruction needs, and potentially what forms of financing can be brought to bear. So I think there's some important work that needs to be done. The World Bank issued a couple of days ago, about a week or so, or I guess, recently, a report which just showed the impact of the war on the Gazan economy and the rest of the West Bank. The impact is very severe. And we need to start thinking from now, what do we do post-conflict, whenever that happens?
Okay, so we're almost out of time. We started with Yevgeniya, so maybe I'll just come back to Yevgeniya and see if you have any final thoughts or reactions, Yevgeniya, in a minute or so, and then we'll close up.
Thank you, Tim. Yes, maybe also to address one of the questions in the chat and in relation to not crowding out the private sector. I think it is we see that GCC countries, they are increasing, of course, investments, right, and capital investments. That is in line with their visions and developmental strategies, and we welcome these developments. But it is also important that reforms that support the private sector, right, like the regulatory reforms, the reforms that improve the business environment, strengthen the governance frameworks, improve the competition laws, strengthen those competition laws that would allow this level playing field between the government entities and private sector, that all these are strengthened and advanced, or that they continue their labor market reforms, making the labor market more dynamic, improving human capital within the region, also increasing the participation of women, right, in the workforce. All this will help countries to basically grow and develop the private sector, and will help the kind of those both pillars to public and private sector to support growth in the medium and long term. I'll stop here.
Great. Okay, so thank you all very much for attending. Thanks to Yevgeniya, Alia, Amine, and Nasser for a really great discussion. I think covered an awful lot of ground. For those who haven't read the IMF report, I encourage you to go and do it on the IMF website. I think it is, as Nasser and Alia have said, it's a fountain of information on the region. And yeah, once again, thank you very much for participating. Bye-bye.